This will be a quick introduction to the topics of Chapter 4 in Advanced Accounting. Back in Chapter 3, we talked about how to consolidate the financials of a parent corporation with one or more of its subsidiaries. So look at the example on the screen, trying to keep it very simple. There's a subsidiary. It only has one asset. It's a piece of equipment. It's on the books at $100, but when the parent acquired the subsidiary, we think that equipment has gone up in value and that it's worth $300. So back in Chapter 3, the parent bought 100% of the subsidiary, and then our rule when we did the consolidation, we would bring that equipment over at its full fair market value of $300. We'd bring the book value of $100, and then we'd have an A entry to bring over that excess of $200. In Chapter 4, we're going to look at a complication that's going to arise if we don't buy 100% of the subsidiary. So in the example on the screen, let's assume instead of 100%, the parent acquired 80% of the subsidiary. Subsidiary still has the same equipment, but now the other 20% of shares are owned by these other people. So when we consolidate the subsidiary, we are now going to be responsible for somehow keeping track of the 20% that belongs to those other shareholders. And in this chapter, those other shareholders will be referred to as the non-controlling interest. The parent has the controlling interest in the subsidiary, and those other shareholders, since they collectively have 20%, they are the non-controlling shareholders. Until a few years ago, this was referred to as majority shareholder and minority shareholders, but now GAAP wants us to use the terms controlling shareholder, the parent in this case, non-controlling shareholders, those other 20%. So you might be wondering, why does this cause a problem? Doesn't seem that complicated. Let's take the balance sheet. We as the parent need to consolidate the subsidiary because we control that subsidiary. Even though we're an 80% owner, we control it. So the question is going to be, how much should we put on our own consolidated balance sheet for the subsidiary's equipment? Theoretically, we have some options here. We could bring over 100% of the book value. We could bring over instead 100% of the fair market value of the equipment, 300, or we could do some kind of blended number where you bring 100% of the book value and then 80% of the fair value. Believe it or not, until a few years ago, there was no answer to that question. Some companies did each of the options that I just laid out. But you and I are in luck now. FASB has cleared this up and told us specifically which way they want us to go. So there's only one right answer now instead of three potentially right answers. The correct answer is you should bring over 100% of the fair value of the equipment. It doesn't matter that you own 80%. As long as you are controlling that subsidiary, the rule will be 100% of the fair value of the equipment should be brought onto the parent's consolidated balance sheet. So, as the parent, we're going to consolidate the subsidiary onto a consolidated balance sheet. The rule is bring over 100% of the fair market value of the equipment. So that's what I've done here. So you're looking at a consolidated balance sheet. Again, seems pretty simple, but now this brings up another problem. This consolidated balance sheet is for the parent's shareholders. But remember, the parent shareholders don't actually own 100% of that equipment. So right now this is a little misleading for them because we're telling those shareholders, hey, you have some equipment, $300, but they actually only own, the shareholders of parent only own 80% of that equipment. How are we going to get this so it's not misleading? So what FASB tells us to do is in the stockholders equity section, we have to add a new line that reports what part of that equipment is actually owned by those other non-controlling shareholders. So in the simple example that I set up, there were no liabilities at the subsidiary. Its only asset was that one piece of equipment. So we'll bring over 100% of the fair value, and now in our stockholders equity section of the parent's consolidated balance sheet, new account, non-controlling interest, $60, to let the parent shareholders know that part of those assets are actually owned by some shareholders that are not shareholders of the parent corporation. Why is it $60? $60 is 20% of the $300 equipment balance. That's how we're going to handle things on the balance sheet. We also have to think about, is this going to cause trouble on the income statement? And again, the answer is yes. The first question we're going to have to answer is, what percentage of the subsidiary's revenues and expenses should we bring over? What if we're 80% owner of the subsidiary? Should we bring over 80% of the revenues, 100%, or some other number? Good news. The very consistent with the previous. The answer is bring over 100% of the revenues and expenses. Now we have another problem though. We're bringing over 100% of the revenues and 100% of the expenses, but we're doing this income statement for the shareholders of the parent. Well, the parent shareholders don't get 100% of the difference in those revenues and expenses, do they? 20% of that income is going to belong to some of the shareholders. So now we have a problem, but we're going to fix it. But it's going to make our income statement more complicated. Back in introductory accounting, you learned that income is sales minus expenses. Not going to be that anymore. We now have to add a subtotal. So rather than saying that's net income, we're going to say it's consolidated income. So you're going to combine 100% of the parent's revenues with 100% of the subsidiary's revenues. Do the same thing for expenses. Figure out the difference in revenues and expenses, and that's going to be consolidated income. The problem is that does not all belong to the shareholders of the parent. So we're going to have to take that number and break that down into two parts. What part belongs to the parent shareholders? What part belongs to the non-controlling shareholders? The problem is that consolidated income does not completely belong to the shareholders of the parent. Remember, part of that revenue, part of that expense belongs to those non-controlling shareholders. We need to show on our consolidated income statement what part belongs to them. So we're going to do that by having those two lines. We'll first subtract out what part of the consolidated income belongs to the non-controlling shareholders. When we back that out, all that's left, all the income left belongs to the controlling shareholders. That is the shareholders of the parent corporation. Let's work through a simple example to see how that would work on a consolidated income statement. On January 1st, 2013, Grimes Entertainment purchased 80% of Zombie Inc. for $2 million even. Assume that any excess purchase price was assigned to goodwill. That's a simplification so that we don't have to do any amortization in this acquisition. The two companies reported the following balances for the year 2013. So they give us the revenues and expenses for both the parent, Grimes, as well as the subsidiary, Zombie Inc. Our job is to now prepare a consolidated income statement for the year ended, it says 2014, let me fix it, for the year 2013. Okay, so again, the rule was bring over 100% of the subsidiary's revenues. So of course the parent gets all of its own revenues plus 100% of Zombie's, so the consolidated revenues should be $800,000. Next you move to expenses. Again, the rule bring over 100% of Zombie's expenses, so as you can see on the screen, consolidated expenses should be 400 plus 160, so 560. And recall that our new subtotal is called consolidated income. So 800 minus 560 would be 240,000. Now again, that 240 does not all belong to the shareholders of Grimes. So we need to remove the part. In the next line, we're going to remove the part that belongs to the non-controlling shareholders of Zombie Inc. Now this is the most common place for students to make a mistake, is they will automatically take the 240, multiply it by 20%, and say that's the part that belongs to the shareholders of Zombie. But that's wrong. The shareholders of Zombie only own stock in Zombie. They don't own a single share of Grimes. So none of Grimes' income belongs to those other shareholders. Only 20% of whatever Zombie has as income. So if you look just at Zombie, you can see it had income of 40,000. So you got to take 20% of 40,000, giving you 8,000. So 8,000 is what belongs to the non-controlling shareholders. So our new bottom line number is not net income, it's income for the controlling shares. And that's going to be 240 minus 8. So 232,000 is the income for the controlling shareholders. That would be a consolidated income statement combining Grimes and Zombie. This, again, income statement is for the benefit of the Grimes shareholders. The Zombie shareholders would get a separate income statement that only covers Zombie. Okay, this was a good introduction. Hopefully this made sense and we'll be able to hit the ground running on Tuesday.